Hey, Paul Mauro here, back, Smart Financial. Today we're going to talk about rescuing your retirement. Go to zero at age 63 for some reason. You had a bankruptcy, a divorce, a marital dissolution, whatever, and you want to retire in 10 years. How are you going to do it? We're going to do it right now. You stay to the end of this video, by the way, and go ahead, email us, ask some questions, and you know what? We're going to get you some free copies of my second book, Smart Financial Longevity Planning. And if you're lucky enough to be a grandparent, let us know if you want a copy of Smart Financial Grandparenting. Book 3 is not out till June, so I can't promise that to you yet. But by the way, if you attend our conference in September, I'm going to be signing copies of all these 3 books. And if you're a subscriber of ours, you'll be able to get free copy of that signed book, as well as spend 2 hours with us talking about money and hearing some great guest speakers. How do we rescue your retirement? It reminds me of when my children were little and they watched the Disney movie, The Rescuers. Who will rescue me? You will rescue you, right? You can rescue your entire retirement plan going from 0 to about 3 million in 10 years if you follow these instructions I'm going to give you, because we have actually seen it done. I ran a financial practice for about 50 years. I've got a little real life experience in doing this. Not everyone is as lucky as a Warren Buffett or a Charlie Munger. They didn't just buy investments in their 20s and 30s, keep them forever and become spectacularly wealthy. Life gets in the way. Things happen along the way, as John Lennon says, when your life happens, when you're planning to do something and then life gets in the way. So here we go. Let's talk about starting again at 0. Let's just imagine all of you that are out there that had something happen to you and you're basically at 63 and you're thinking, oh God, I don't want to work forever. I'd like to get out of this in 10 years. What am I going to do? So let's just talk about real actionable items that you can do right now. So first and foremost, this is a case right out of our real files of people that we've helped over the years. Everything I'm talking about, you can get more information. Some of these stories are actually in the books that I've written for grandparents and ex-geners and millennials. All those stories are like real stories of action. So first and foremost, be positive. You can do it. As long as you've got your health and you've got the will to work, right, you can put together a very substantial and comfortable retirement in just a 10-year plan. So first and foremost, if you have a home, keep it. Don't sell it. Don't cash out. Don't move to an apartment. Don't do anything radical like that. One of the best assets for wealth building in America is your home. And if you have your home, even if it's a little bit mortgaged up and all that, do your level best to keep that home for the next 10 years. Pay that mortgage for the next 10 years. Build up equity for the next 10 years, because under the current rules that are in effect now in April of 2025, when I'm talking to you, right? The retirement part can include using equity in your home. Now, we just did one of these, and I will just tell you exactly how it came down. It was a midlife career crisis person, lost their job, their benefits, and everything midlife. We had to put it all together in 10 years. They got to their 70s. They had equity in their home. They used the current, really much improved reverse mortgage retirement plan. If you've got that, it's the reverse mortgage retirement plan that allows you to take equity out of your home. It's not an equity line. It doesn't create a check you have to write every month. It is exactly the opposite. Instead of a forward-going mortgage, it's a reverse mortgage where they basically either pay you money, or in this case, they gave him a lump sum of money, and he took that money and was able to put it in his portfolio to buff it up to get more income. Now, here's the interesting thing about reverse mortgages today. Don't even consider a reverse mortgage on your home if your children really want to inherit a fully paid for house. Now, if they want to inherit a fully paid for house, there's a technique for that we can talk about in a minute. But a home has leverage and builds a lot of wealth really fast. So if you're paying your mortgage payment and you have the growth on, say, a $500,000 house over the next 10 years, that thing's going to grow to like $800,000 or $900,000. And that's exactly what happened to our client. His $500,000 home grew to $800,000, and on the reverse mortgage, they gave him half. That's tax-free money, by the way. They actually wrote him a check for $400,000. Now, you could also convert your home to a check every month, but in his case, he took the lump sum. So keeping your home, paying for your home, not selling your home is the smart thing to do if you're rebuilding your finances. Second, insurance. Insurance is a really big deal. Insurances of all different kinds are very, very important. And I do think that if you're young healthy, and by the way, at my stage in life, if you're in your 60s and you're not suffering from some terrible medical things, you're young and healthy. So if you're young and healthy, you should seriously consider owning a substantial amount of insurance. Why? Well, a couple of reasons. If you have people you like in your family, children, etc., it's important to have insurance. If you still have a mortgage on your home, well, it's important, to pay off the loan so maybe the kids can get the house, whatever. But there's a third reason. The third reason that's really important is using your insurance as part of your retirement plan. And this is exactly what happened with our client. They got to be 73 years old. They had about $1 million of insurance, and they used what is called life settlement. What does life settlement mean? It means that another company bought the policy from them and gave them a big fat check. Now, depending on your age, your health, your circumstances, the numbers are all over the place, but use as an example about 50% of the insurance amount. So he had $1 million of insurance. He got a tax-free check for about $500,000. The first part of the retirement was the reverse on his own home, which added about $400,000 to his empty portfolio. The second part of his retirement was maintaining life insurance he could sell late in life. Now, you should know, under the current regulations today, you can't actually go into a transaction and say, I want to buy this insurance so I can sell it later. You need to have a real need for insurance and you should buy it. However, you should know in the back of your mind, under the current new, very, very revolutionized rules for life settlement, should you find yourself at age 73 with maybe not quite enough cash, however you have some insurance, it is a very common transaction now. We've done a lot of them. And we've got clients receive as much as $1 million for their $2 million policy or whatever, based on their age and stage in life. So life insurance has become one of the most important assets. You can't escape the commercials. Why are they advertising so much? Why is it all over the news waves? Why is it on every business station? Not why. Regulations have cleaned up, and you'll hear them say that transactions have to be done by a properly licensed broker. Of course, you have to work with someone who's properly licensed to do a life settlement transaction in the future. So, reverse mortgage number one, life settlement number two. Number three, what did we do? We sat down and we had a heart-to-heart about this person's situation because he really ended up with zero at age 63. He had a lot of experience, he had a great job, but all that was not going to be good enough to get him out. So essentially he changed careers and he went into a different job and he went into a different corporation and he went into a company which had a pension. Now let me explain. A 401k is the kind of plan that you pay money into. That means it comes out of your pay and it goes into your account, and that's all very nice. It's especially great for young people. And I've said many times, if you are starting your career and you have an opportunity to put money away, it's just awesome when somebody who's 30 already has $100,000 saved, because that person's going to be a retirement millionaire. Well, this person at 63, we'll call him Ted. Ted was basically zeroed out. So what was he going to do? He could go into his 401k plan and start saving $20,000 a year and all that. However, what he did is much more creative. We searched for the companies that had pension plans. Now, a pension plan is very common in municipal employment. There's, of the Fortune 1000 companies, 35% still have pension plans. And if you do 10 years, normally it's 10-year vesting. Now, Ted didn't get vested in 100% of his income, because that would take 20 years, but he got vested in 50% of his income. So he went into that career and he said, I'm going to take this career job. I'm in my 60s. I'll make $100,000 a year for the next 10 years. And then when I retire, they're going to pay me $50,000 for life, or 50% of his income. And Ted didn't have to put away a dime for that. So what is that actually worth to a person like Ted? He also had the opportunity to do some savings, but this took no money out of his pocket whatsoever. He got to 73 years old. As a 73-year-old person, that's the new sort of retirement minimum distribution age. It's a much more common retirement actually than age 65 or 66 nowadays. So he got to 73, and we did a little look backwards at what he accomplished in 10 years. He got $500,000 out of his home, $400,000 out of insurance. That's $900,000 in cash. He had fully qualified for his Social Security, which was like $35,000 a year. And he got a pension from his employer, which I had to look at my notes, was like $42,000 a year. So he had $72,000 in pensions, another $30,000 from his portfolio. Ted retired with about $119,000 or $120,000 a year, and he did it in 10 years. Now, what is that the equivalent of? When someone says, what's your retirement worth? If you have $3 million in your retirement and it's paying you 4% a year, that's about $120,000. Ted built up a retirement life equivalent to having $3 million, and he did it in 120 months. And you can do it too. So late life retirement rescue is possible, but you need to be very cognizant that most pension plans have a 10-year window. So let's recap. Number one, don't sell your house. Keep working, keep paying the Social Security, keep building up that benefit with the plan that you'll probably take equity out later. Number two, don't dump all of your insurances, because your life insurance now has 3 benefits. Life insurance if you die, most of them pay if you got sick, and the third part is they're sellable for cash in retirement as life settlement. Okay? So then the third thing is, if you have 10 years or more to go prior to retirement, you are an excellent re-employment candidate. Get yourself re-employed, even if you get re-employed at a career that's paying you less in cash dollars, but has a spectacular defined benefit pension. Now, if you want more information on this, I will tell you that in my book on smart financial longevity planning, we have a lot of chapters about getting yourself organized for a smart financial retirement without breaking the bank. So if you're like Ted and you have to jumpstart your life midterm, right, or in your 60s, more than midterm, you can still build a successful retirement plan with the help of your financial advisors. It's chapter 14 in the book, with the help of some creative planning, because creative planning to get you to a retirement is just part of the art of being smart.